Hey guys, welcome back to the Economics or Finance Excellency batch. I'm your friend, I'm your mentor, CA Saurav Jindal from KSJ Teaching, and you are watching our YouTube channel KSJ Teaching. If you are new to the channel, please subscribe to the channel and do not forget to hit the like button. Okay, so what we have been discussing so far, we have been discussing about the national income. We discussed about the various components of the national income, that how it is being calculated, what are the various components that make the national income. Then we discussed about personal income, disposable personal income and all those things. And some practical problems also we have done in the last part. So now in this lecture, what we are going to start with is, sir, is the practical part over? No, the practical part is not yet over. We have to do a lot of practical problems we'll be doing, but after discussion of this topic, right? Okay, so the next topic that we have is measurement of national income, that how it is being measured, what are the various ways or what are the various methods. There are three different methods by which the national income can be measured. See, what we have studied so far is the various components of national income. Those are going to remain same, right? But how to use those components, there are various methods of that. Okay, so this part is just the basic information of it, nothing as such relevant from the examination point of view, right? That national account statistics in India are compiled by the National Accounts Division in the Central Statistics Office. Annual as well as quarterly income estimates are published in India. Income is the national income estimates. Ministry of Finance uses the GDP at current prices as the base to fix the fiscal targets, that what is the current level of GDP. According to that, the further fiscal targets are set by the government, right? That how much you need to achieve, what are the areas that need correction, how the GDP, how we can increase the GDP, right? Because the GDP, as we studied, shows the performance, the national income shows the performance of the nation, right? So accordingly, all these things are set. After that, we say Ministry of Statistics and Program Implementation has revised the base year from 2004-5 to 2011-12 for the calculations. The base year, if you we have studied about nominal GDP and the real GDP, right? For that, the base year earlier was 2004-5. Now it has been moved to 2011-12. Sector-wise estimates of the gross value added will now be given at the basic prices instead of the factor cost. We'll study about it, right? Nothing as such relevant from the examination point of view. This was just the basic information that was there, right? Okay, now starts a very important concept, that is the circular flow of income. Now, what is the circular flow of income? Try to understand. Try to understand this circular flow of income. This is very, very important. Okay. Very easy, you will be able to understand easily. Circular flow of income. I'll just explain it with the help of an example so that it becomes very easy when we read it out. Okay, now what is the circular flow of income? Sir, the circular flow of income says that I am a manufacturer. Here is a manufacturer, Mr. A, right? He manufactured some goods, right? Manufacturer of goods. He is a manufacturer of goods. Now, when he will manufacture, he manufactured some goods. From here, what will happen, sir? He will take the help of the labor, he will take the help of the money, right? He will take capital, he will pay interest on that. Now, in the manufacturing of the goods, what he will do is, once he is done with the manufacturing, he will pay to the factors of production. Pay to factors of production, isn't it? He will pay to factors of production. Am I right? Yes, sir. Absolutely correct. Now, what happens? This becomes the factor income. This is the factor income. He manufactured the goods, and in the manufacturer, he has taken the services, right? For the services, he will pay to the factors of production. Now, this factors of production, this becomes your what? This becomes the factor income. That is to whom this income has been paid. For Mr. A, this is what? For Mr. A, this is factor cost. This is factor cost. But for these people to whom Mr. A has paid, who have received the money, that is a factor income. Now, once they have received the income, what will they do? Sir, they will spend money in buying some goods, right? These factors of production, what will they do, sir? They will spend money in buying goods. What they will do is they will spend money in buying goods. Spend this money which they have received, spend this money in buying goods and services, isn't it? Obviously, sir, you are earning money, you earn that money and you spend that money, right? Now, what will happen when they are spending this money on buying the goods and services? That means there will be more manufacturing of the goods and services, isn't it? Sir, you are consuming some goods, you are consuming some services. Obviously, the manufacturer will make more goods, more goods, more goods. So this circle will go on. The goods, more goods will be manufactured. Then the payment will be done to the factors of production. The factors of production again will spend the money in buying some goods and services. Again, those goods and services will be manufactured. This is known as the circular flow of money, right? Where the manufacturing of the goods take place in the economy, and after the manufacturing of the goods, the payment is done to the factors of production, which is the factor income for these factors of production. Now this factor income is spent on buying the goods and services, and once you are spending this money on buying the goods and services, more goods will be manufactured, right? So this is basically a circular flow of income, that how this income flows from one source to another source, right? From one source to another source. You manufactured the goods, paid to the factors of production. This is a factor income for the factors of production. Then they are spending the money. That becomes the income for someone, right? That becomes the income for the business. Now business with that income will manufacture more goods. So this flow of income will continue to happen, right? Now let's read it out. What is there? We are given in the book. So handbooks, all of you must be having with you, right? Which is very, very important for you guys. Now the circular flow of income refers to the continuous circulation of production, that is manufacturing of the goods by Mr. A, then income generation, that is the income of the factors of production, and expenditure, that is the income that the factors of production are earning, then they will be spending that income, right? Involving the different sectors of economy. The flow of income relates to three distinct phases of economic activity. First phase is the production of goods and services, right? Which Mr. A is manufacturing the goods and services. That is the first phase of this income flow. The second phase is distribution of factor income. Distribution of factor income means this becomes the second phase, when the factors of the production are receiving the income, right? So I'll mark it here. This is this manufacturing of the goods. This is your phase 1. This is your phase 1, right? When these factors of production will receive the income, this becomes the phase 2, right? And this expenditure part, this is what? This is your expenditure part. This becomes your phase 3. This becomes your phase 3. Clear? So that is what is given here. We say that there are three phases. The first phase is the production of goods and services. Second is the distribution of factor income. And third is the disposition of income. Disposition means the expenditure part. Spending of income, expenditure, or we can say the spending of income, right? Spending of income. This is known as disposition of income. So this is how the circular flow will go. Phase 1 is production of goods and services. Phase 2 is distribution of factor income. And phase 3 is disposition, that is consumption or investment. It is not like they are going to spend only, they might be investing that money, and through investment also they are earning the money, right? So it can be anyways. So this is basically the circular flow of income. Further, we have discussed a little bit about the different phases. So phase 1, what is phase 1? The production of goods and services. During this phase, the firm produced the goods and services with the help of the various factors of production. The market value of all the goods and services produced during this phase is known as the gross domestic product at market price, which we have already studied about, right? that whatever is being manufactured within the domestic territory of a country in a period is known as GDP. So here also we are saying that the firms are producing the goods and services with the help of factors of production, obviously, right? Without the factors of production, nothing can happen, isn't it? So whatever is the market value of all the goods and services which are being manufactured during this phase, that is known as gross domestic product at market price. Clear? Then is the distribution of factor income. Now, once the goods have been manufactured with the help of the factors of production, the manufacturing unit will have to pay to the factors of production. For the services provided during the first phase, the factors of production will receive the income by the way of rent, compensation of employee, interest, profits, etc. These are factor payments from the viewpoint of firms and factor income from the viewpoint of households. That is what I told you, right? This is a factor cost for the manufacturer, Mr. A, who is making the payment for that, for Mr. A. This is what? This is a factor cost. But for the factors of production who are receiving this income, for them it is a factor income. Clear? Right, sir. Further, we say the disposition phase. In this phase, the income received by the different factors of production under the second phase is spent on consumption of goods and services. This expenditure leads to further production of goods and services and sustains the circular flow as already discussed with you guys, right? So this is very important phase to understand. Clear? I hope this much is clear. What is a circular flow? That you are manufacturing the goods, and after manufacturing you will pay to the factors of production because you have taken the services of those factors of production, and the factors of production, once they receive the money, they will be spending that money on the further buying of goods and services. Again, that circle will start. Again, once you have consumed the goods and services, more goods and services will be manufactured. Again, the factors will be paid. The factors again will receive the money and they will be spending the money on some goods and services. So that is the circle that will continue, and that sustains the flow of money in an economy, right? If that phase stops means if you are manufacturing goods and services, you pay to the factors of production, but factors of production stop consuming the things, right? Then what will happen? How will the money flow take place? How will the more goods and services be produced? Then there will be no business and nothing as such, right? Are you getting the point? So that is why this is important for the circular flow of income, right? Clear, sir? This much is clear, I hope. Okay, so let's move further. Now we say each of the three phases suggests a different method of calculation of national income, and each method requires a different set of data. Now he says whatever these phases we have studied about, every phase, phase 1 will give you a different viewpoint for the calculation of national income. Phase 2 will give you a different method and a viewpoint, and phase 3 will give you a different method and a viewpoint of calculating the national income. So we are now going to discuss these views, right? So in this lecture, we'll be discussing about the first view. Let's start with that. So there are the methods of measuring the national income. The first method is value added or the product method. What is value added or the product method? See, Mr. A is manufacturing the goods, right? Manufacturing the goods. By manufacturing, what he is doing? He is manufacturing a product. We call it a product method, right? He is adding some value to the product. How he is adding some value to the product? Mr. A buys cloth. Mr. A buys cloth, right? Now, the cloth manufacturer, when manufactured the cloth, that is added in the GDP at MP. Now, on this cloth, he makes a t-shirt. From this cloth, he makes a t-shirt. Now, what is he doing? There, he is doing the value addition. He is doing value addition to the cloth, right? And how is he doing value addition to the economy, sir? By making this t-shirt, selling this t-shirt in the market, is adding the value in the economy also, right? Are you getting the point? So this method is value added or the product method, also known as industrial origin method versus or the net output method or the inventory method. Right, so everything is related to the product. Why here? Because in the phase 1, what we are focusing on is we are focusing on the manufacturing, right? We are focusing on the production of goods and services. That is what phase 1 is all about. That is why I say in this part, in this phase, what we are focusing on is the product, the inventory, the output. We are focusing on that. Based on that, these names have been set: value added or the product method, or what it is known as industrial origin method or net output method, or the inventory method. Every individual enterprise adds certain value to the products which it purchases from some other firms as the intermediate goods. That is what I told you in this case. In this case, what is here, sir? This cloth is what? This is an intermediate consumption. This is an intermediate product for whom? Mr. A. Now, Mr. A, when converting the cloth into t-shirt, what is he doing is he is adding the value to that product. Right, that is why it is known as value addition. You increase the price of that, right? Mr. A buys the cloth, let's say for 100 rupees. Once he is converting it into t-shirt, he is selling it for 1000 rupees, right? So 900 is what? 900 is the value addition. 900 is value addition. Clear? That is why it is known as a value added method. When value added by each firm is summed up, we get the value of the national income. Therefore, the value added method measures the net contribution of each producing enterprise in the domestic territory of a country in an accounting year, right? So, net contribution of each producing enterprise, that means a manufacturer, in the domestic territory of a country in an accounting year. So, what he is talking about basically, he is basically talking about the GDP, sir. Within the domestic territory in an accounting year, right? Not GDP. From GDP, you will go to the NDP because he is talking about the net but net contribution here will mean what is value addition, or here we are talking about the net contribution. What is net contribution? One is the depreciation part from gross to net. That is one angle. Another angle is net contribution. When he is saying, he is talking about what? He is talking about the value of output. He is talking about value of output minus intermediate consumption, which we have already studied about. Intermediate consumption. Clear? Value of output minus intermediate consumption. That intermediate product was for 100 rupees. You are selling your final product for 1000 rupees. So this 900 rupees is your value addition. It is the net contribution that you are making to the economy. Clear? So steps involved in the valuation. What are the steps involved in the valuation of national income using the value added or the product method? That is what he means. Okay. So what are the steps? Classifying all the producing enterprises into three major sectors: primary sector, secondary sector, and the tertiary sector. These sectors are further divided into subsectors and subsectors into commodity or the service group. Clear? Now, what is he trying to say? He says you have to divide the economy into three sectors. You have to divide economy. To calculate the national income, you have to divide this economy into three sectors, right? First, second, and third sector. Okay, so what is that? The first will be the primary sector, right? The second will be secondary sector, and the third will be tertiary sector. Tertiary is service sector, sir. Primary is agriculture sector, right? So you have to divide it into various sectors. Then after that, these sectors will again be further divided. These sectors will again be further divided, let's say, into subsectors. These will be further divided into subsectors. For example, sir, if we are talking about a manufacturing activity, okay, so first we'll see what is a primary sector. What is a primary sector? Okay, that is also important to see, sir. What is a primary sector? What are the examples? Agriculture, agriculture is a primary sector, right, which is required for sustaining this economy, which is the base here, sir. Without agriculture, how can you have food? You cannot have food. How can you sustain? You will not be able to sustain, right? So this is the very basic sector, the agriculture sector, or we can say the raw material sector, the sector which is providing the raw material to the industries. That is also a primary sector, right? The sector which is of primary importance, Okay. After that, secondary sector, sir, manufacturing units becomes my secondary sector. And what is your tertiary sector? The service sector, basically. Service sector, which is providing the services, like the IT companies are there. So all these are covered in the tertiary sector. Now, what we are saying is that this primary sector is further divided into subsectors, right? Further divided. The secondary sector is also further divided into subsectors, right? For example, in the manufacturing part, one can be a textile sector, one can be another hosiery unit sector, right? So one can be iron and steel manufacturing. So we are dividing this into subsectors. Similarly, for the tertiary also, we have the subsectors. Like one is IT, then another can be related to some machineries and all those services, right? Any kind of services can be there. So he says, firstly, the economy is being divided into three sectors: primary, secondary, and tertiary. Then these sectors are further divided into subsectors. Then he says, further, sir, any other further division? Yes. He says these subsectors are again further divided, into commodity sectors, right? They are further divided into small unit sectors, right? Commodity sectors, we can say, or what we call it as units, right? We call it as units also. So this is commodity sector 1, 2, 3, 4, 5, 6. I mean, every subsector is further divided. This is just the naming that I am giving. Okay. Clear? So this is what he means to say here, that every sector is being divided into primary, secondary, and the tertiary sector. Then these sectors are further divided into subsectors, and the subsectors into commodity or the service group. Clear? Then he says the first thing that we calculate is what is the gross value added by each producing enterprise. He says first we will calculate the gross value of these commodity sectors. We will calculate the gross value. Okay, I'll write it separately so that it is more clear to you guys. What he means to say is, he says the first we will calculate the gross value addition, right, of what? Gross value addition of commodity sectors, or the small sectors or the units that we have decided, right? This is the GVA this is GVA 1, right? I will name it as GVA 1. That is the gross value added by the smallest unit, that is by these units. Now the sum total of this gross value, right? Sum total of this commodity sector's value will be what? Leading to the GVA of the subsectors, right? And the sum total of the GVA by subsectors will give us what? Will give us the GVA of the main sectors. Main sectors means the primary, secondary, and the tertiary, right? Sum total, and the sum total of this will give us what? At the national level, GVA at the national level, right? GVA at national level. Clear? So this is how we start with the lowest unit. The sum total of the lowest unit, the commodity sector, will lead to the sum total of the subsector. Sum total of subsector will give us the total of the main sectors, and the sum total of the main sectors will give us for the economy. That is what he's saying. Each producing enterprise, right? So this is what? This is an each producing enterprise, right? Everyone is contributing something. isn't it? Every sector, everyone is contributing something. So GVA at MP is equal to value of output minus the intermediate consumption, that is net contribution. Net contribution, value of output minus intermediate consumption. Now, how the national income is calculated? The first thing, from gross, we need to go to the net concept, right? So from GVA at MP, you minus the depreciation. Now here you have to take the market price, because when we are talking about the value of output, that is the market price that we are generating, right? What is the market price that we are generating? What is the price at which we can sell our product? We will be selling our output. What is the final value of that output? That is the value addition. Clear? So from gross concept, we will be going to the net concept. We will subtract the depreciation, right? You are getting the net value added at market prices. Now, if you want to convert the market price to factor cost, look at this. NVA at FC, that is NVA at MP minus the net indirect taxes. You will get NVA at FC. And for national income, what will you do? You will go for NVA at FC plus NFIA, because up till then here gross value addition, this is basically GDP at MP, right? And here it is NDP at MP, right? Because what we are taking here, the first thing that we say here is the net contribution of each producing in the domestic territory of a country. That means here when we are taking the contribution, we are talking about only the domestic part, right? We are calculating GDP at MP. So NVA at FC, this is your GDP, this is your, NDP at FC. Now from domestic to national, national income is what we have discussed, NNP at FC. So from domestic to national, we add net factor income from abroad. Clear? So this is the estimation of national income by the value of output method. That is the value added method, product method. That what is the value addition by the manufacturing enterprises? What is the value addition by manufacturing enterprises? That how they add the value? They buy the raw material, they do the processing on raw material, and they sell the final product to someone, right? That generates my national income, right? For that, the economy has been divided into various sectors into subsectors into commodity sectors, and we try to find out the sum up of the value addition by each enterprise starting from the bottom, right? Here, see, the sum of the net value added of all the units in the subsector gives the net value added by a subsector. Sum of the net value added by all subsectors gives the net value added by a particular sector. Sum of the net value added by all the sectors gives us the overall net value added. That is what I told you, that combining this, you will get for one subsector. Combining these two subsectors, you will get for the primary activities, and combining the primary, secondary and tertiary, you will go to the economy national level, right? So starting with the smallest subsector, going up to the economy level, calculating the national income, right? So he says, what are the inclusions in it? The own account production of fixed assets by the government, enterprises and the households. That if you are manufacturing a fixed product, you are not buying a fixed asset from outside, right? But you are manufacturing a fixed asset for own consumption, right? That is also a part of national income, because you are manufacturing something, you are in that manufacturing process, you will be taking the help of the factors of production, you will be paying them, right? So there will be a circular flow of income. So that will be included in this value addition. You are adding some value, sir, because you are going to use those fixed assets in the manufacturing of the product, and ultimately you are contributing to the value addition, right? Then is the production of goods for the self-consumption, because here also you are taking some manufacturing part. If you are producing the goods, right, using some raw material, you will be manufacturing the goods, and if you are using the raw material, you are converting that raw material for the production of the goods, right? There will be flow of money, there will be manufacturing of the process. Even if you are going to self-consume those goods, you have added the value, you will be paying money to that person from whom you are buying the raw material. Or if you are producing the goods for self-consumption, you will be taking the help of whom? The factors of the production. Again, you will be paying those to those factors of production, right? Then is the imputed rent of the owner occupied houses, that is the notional rent. Now he says this is again a part of national income, value addition, right? That if you have self-occupied houses, but the notional rent that had that house been on the rent, then what is the income that you must have generated, right? Because there is always an opportunity of giving that house on rent, right? Even if you have occupied it self-occupation, that is very good, but still there is an opportunity, there is an opening that that house might have been given on rent and you might have been earning the income. That is a contribution. Rent. What is what? Value addition, right? Okay, after that, net increase in the inventory will be added in the national income as a part of capital formation. That is absolutely correct. Whatever is the increase in the inventory, why there will be a net increase in the inventory? Because you are manufacturing the goods, right? You are manufacturing the goods, and as you keep on manufacturing, your inventory will keep on changing. The increase in inventory means you have manufactured more goods. Manufacturing more goods means you are adding more to the value, right? So that will be included in the national income. Exclusions, value of intermediate goods, that we have already discussed. Sale and purchase of the second hand goods. Why it is excluded, the second hand goods? Because the value of it, because why this is excluded? Because the value of these were added, right, when these goods were manufactured, right? So here what is taking place? It is only the sale and purchase transaction that is taking place. There is no as such value addition that we are doing. We are not buying the raw material, doing some processing and value adding. No sir, it is a second hand good. I am selling my mobile to some other person, right? Am I adding value? No sir, that value addition was done when that mobile phone was manufactured and sold to me, right? That was the value addition. Then is the production of services for the self-consumption. For example, the services of a mother in the kitchen. Can you value it, sir? No, sir. There is no value out of it, right? It is invaluable. Clear? If you are providing some services for the self-consumption, like the services of a mother in the kitchen, you cannot value those services, right? There is no value that you can assign to those services, and as such, it cannot be added in the national income. It is beyond all these concepts, right? It is beyond all these concepts, as we all know. Clear? This is clear. So this was the first method based on phase number 1, because the phase number 1 was related to production of goods and services, and related to that we have done the first method, that is the value added or the product method, right? Related to phase 1, that is production of goods and services. Now what is the second phase? The second phase is distribution of factor income. So we are focusing something on the income from this aspect. The next method that we will be discussing in the next lecture is the income method of calculating the national income, right? Then we will move on to the last method, that is the expenditure method, right? So see you guys in the next lecture. Till then, stay safe, stay healthy, keep studying, keep sharing. Thank you so much.